Picture a brokerage office on Wall Street. It's late October 1929. The trading floor has finally gone quiet after the closing bell. Ticker tape machines sit idle now, but earlier today they ran hours behind, unable to keep up with the flood of sell orders. The floor is littered with paper, ashtrays overflow. A few men in rumpled suits sit at their desks, staring at nothing in particular. Outside, the streets of lower Manhattan are dark, except for a few street lamps. Somewhere in that building, a telephone rings, and no one answers it. What happened here? How did so many ordinary Americans, school teachers and shopkeepers and secretaries find themselves suddenly wiped out? Why did this particular crash turn into something far worse than anyone had experienced before? And what can modern investors learn from a disaster that unfolded nearly a century ago, when the basic rules of finance had to be rewritten from scratch? If you're listening to this in bed tonight, perhaps after checking your own portfolio or scrolling through market news, you already know that investing can feel like a puzzle with pieces that never quite fit together the way you expect. Tonight's story isn't about quick profits or hot tips. It's about something deeper. It's about what happens when hope meets leverage, when crowds move together, and when the structure beneath a market turns out to be far more fragile than anyone imagined. So settle in, let your mind drift back almost 100 years. We're going to walk slowly through one of the most important events in American financial history, not to frighten you, but to help you understand what happened in October of 1929. We need to go back a few years earlier. The United States in the 1920s was a country transforming itself. The First World War had ended. Soldiers came home. Factories that had been making weapons switched to making automobiles, radios, refrigerators. New technologies were everywhere. Electric lights were replacing gas lamps in homes, telephones, connected cities. Movies had become a national obsession. This wasn't just progress. It felt like a revolution. And for many Americans, it seemed obvious that all this change meant one thing: the stock market could only go up. Interest rates were relatively low for most of the decade. The Federal Reserve, which had only been created in 1913, was still learning how to manage the economy. Money was available, credit was easy, and inflation had been tamed after some rocky years right after the war. The general mood was optimism. The president, Calvin Coolidge, famously said that the business of America was business. Herbert Hoover, who would become president in 1929, spoke about a future where poverty would be eliminated. On Wall Street, the New York Stock Exchange was the beating heart of this optimism. Stock prices had been climbing steadily since 1921. By the middle of the decade, the climb was getting steeper. New companies were going public. Established companies saw their share prices double, triple, quadruple. Investors who had put money into the market years earlier were suddenly wealthy, at least on paper. But here's where the story gets interesting. The people buying stocks weren't just the traditional wealthy class. Ordinary middle-class Americans were jumping in. Your neighbor, your dentist, your child's teacher. They opened accounts with brokerage firms. They studied stock tables in newspapers. They talked about their holdings at dinner parties. Owning stocks became fashionable, almost patriotic. You were participating in American prosperity. Now, most of these new investors didn't have large amounts of cash sitting around. They had salaries, they had some savings, but if you wanted to buy a significant amount of stock, you needed more capital. And that's where margin came in. Margin, in simple terms, means borrowing money to buy stocks. Let's say you had $1,000 in cash. Under the rules of the time, you could use that $1,000 as a down payment to buy stocks worth much more. Often, brokers would lend you 90% of the purchase price. So, with your $1,000, you could control $10,000 worth of stock. If those stocks went up by just 10%, your 10,000 became 11,000. You'd pay back the loan, keep your original 1,000, and walk away with $1,000 in profit. You doubled your money. The math was seductive. And when stocks kept going up month after month, year after year, it seemed foolish not to use margin. Why limit yourself to the cash you actually had when borrowed money could multiply your gains? Brokerage firms loved this system. They earned commissions on every trade. They also earned interest on the margin loans. Banks loved it too. They lent money to the brokers who lent it to the customers. Everyone in the chain was making money as long as stock prices kept rising. The whole structure seemed perfectly stable. Regulators at the time, such as they were, didn't see much to worry about. There was no Securities and Exchange Commission yet. That wouldn't exist until the 1930s. The stock exchanges were largely self-regulating. The Federal Reserve focused mainly on banks, not on brokers or stock speculation. A few voices warned that margin debt was getting dangerously high, but those warnings were dismissed as old-fashioned thinking, the concerns of people who didn't understand the new era. By 1929, margin debt had reached levels never seen before. Billions of dollars had been borrowed to buy stocks. Much of that borrowed money was itself borrowed on a short-term basis, something called call loans. These loans could be called in, meaning demanded back at any time. It was a pyramid of debt built on rising stock prices. Let's paint a picture of one investor. We'll call him Robert. Robert was a sales manager for a manufacturing company in Cleveland. He was in his early 40s, married with 2 children. He'd never paid much attention to the stock market until his brother-in-law started talking about the money he was making. Robert opened an account in 1927. He started small, buying shares of General Electric and Radio Corporation of America. Both stocks went up. Encouraged, Robert bought more, this time using margin. He borrowed to increase his position. By the summer of 1929, Robert's portfolio on paper was worth nearly $20,000, a fortune at the time. He'd only put in about $4,000 of his own money. The rest was borrowed. Robert felt smart. He felt like he'd figured something out. He daydreamed about paying off his house, maybe buying a new car, sending his kids to college without worry. His wife was nervous about all the borrowing, but Robert reassured her everyone was doing it. The market always came back, he said. And besides, he was diversified. He didn't have all his money in one stock. Robert was not reckless. He was simply doing what seemed reasonable at the time based on what he saw around him. And that's an important point. Most of the people who would lose everything in the crash weren't wild gamblers. They were ordinary people who believed in American prosperity and who thought They found a way to secure their family's future. By the summer of 1929, the stock market had become detached from underlying economic reality. Price to earnings ratios for many companies had climbed to levels that made no sense if you looked at actual profits, but hardly anyone was looking at fundamentals anymore. The only thing that mattered was whether prices would keep going on up tomorrow. And since they'd been going up for years, most people assumed they would continue. Um, this is what later economists would call a classic speculative bubble. But at the time, many serious people argued it wasn't a bubble at all. They said the high valuations were justified by the new industrial age, by American innovation, by the fact that the old rules simply didn't apply anymore. This time they said it really was different. Underneath all the optimism, there were cracks forming. The real economy, the one outside the stock market, was starting to slow down. Construction of new buildings had peaked. Automobile sales were flattening. Farm prices had been weak for years, meaning much of rural America wasn't sharing in the urban boom. Consumer debt was rising. Some banks, especially smaller rural banks, had already started failing. But on Wall Street, none of that seemed to matter. The party continued through the summer. In September of 1929, the market hit its all-time peak. The Dow Jones Industrial Average reached a level around 380. Then, almost imperceptibly at first, things started to change. Early October saw the market drift lower. Nothing dramatic, just a few down days, some profit taking. People said completely normal, but the declines continued. By mid-October, some investors were getting nervous. A few started selling to lock in gains. Others sold because they needed cash for other purposes. The selling created more selling. On Thursday, October 24th, the market opened weak and then fell sharply. This was the day that would later be called Black Thursday. The volume of trading overwhelmed the system. Ticker tape machines fell hours behind. So investors across the country had no idea what prices were anymore. They just knew orders were flooding in and stocks were falling. Here's what made this particularly dangerous. Remember all those margin loans. When stock prices fell, the value of collateral backing those loans fell too. Brokers started making margin calls. A margin call is a demand for more cash. If you'd bought $10,000 worth of stock with $1,000 down, and that stock had now fallen in value to $8,000, the broker might call you up and say you need to deposit more money immediately to bring your account back to the required level. If you could then come up with the cash, the broker would sell your stocks to cover the loan. And when they sold, they pushed prices even lower, triggering more margin calls on other accounts. It was a cascade, a chain reaction. On that Thursday morning, panic was setting in, but then something unusual happened. A group of major bankers met at the offices of J.P. Morgan and Company. They decided to intervene. They pooled their resources and started buying stocks publicly and visibly to calm the market. It worked temporarily. The market stabilized. By the close of trading, prices had recovered some of their losses. Over the weekend, newspapers tried to sound reassuring, President Hoover made a statement saying the fundamental business of the country was sound. Bankers gave interviews expressing confidence. Many investors convinced themselves the worst was over. Perhaps it had just been the shakeout of weekends. They thought perhaps now was the time to buy more. But the following Monday, October 28th, the market fell again, harder this time. And then came Tuesday, October 29th. This was the day that would be remembered as Black Tuesday. The market collapsed. Prices fell so fast that even the bankers who tried to support things the previous week couldn't stop it. More than 16 million shares traded hands, a record that would stand for decades. Fortunes vanished in hours. Let's return to Robert, our sales manager in Cleveland. On Thursday, he'd received a margin call. His broker needed $3,000 to keep his account open. Robert didn't have $3,000 in cash. He'd put everything into stocks. He asked for a few days to raise the money. Maybe he could borrow from his brother, he thought, or take a loan against his house. But by Tuesday, it was too late. The broker sold all of Robert's stocks to cover the margin debt. When the dust settled, Robert's entire portfolio was gone. And not just his gains, not just his original $4,000, because the stocks had fallen so far so fast, the sale proceeds weren't even enough to fully repay the margin loan. Robert actually owed the brokerage firm money. He was worse than broke. He was in debt. And he still had his mortgage, his family to feed, his regular job, which now felt terrifyingly uncertain. Robert's story was multiplied across thousands of households. School teachers who thought they were securing their retirement found their savings wiped out. Doctors and lawyers who'd borrowed to invest discovered they owed money they couldn't pay. Some investors, not many, but some, took their own lives in the days and weeks that followed. The psychological shock was immense in the days after Black Tuesday. The question on everyone's mind was whether this was just a sharp correction or something worse. Optimists pointed out that markets had fallen before and recovered. Perhaps this was a chance to buy at discount prices, but the recovery never came. Instead, the market kept grinding lower for weeks, then months, then years. By the summer of 1932, the Dow Jones had fallen to a level around 40. That was a decline of nearly 90% from the peak. You might be wondering why this particular crash led to the Great Depression, the worst economic disaster in modern American history. After all, markets had crashed before. The panic of 1907 had been severe. There had been other financial crises in the 1800s. Why was this one so catastrophic? The answer lies in several interconnected factors that created a kind of perfect storm. Let's walk through them one at a time, calmly and clearly. First, the sheer amount of leverage in the system. The margin debt that had built up during the boom years meant that the crash didn't just destroy wealth, it destroyed borrowed wealth, leaving people and institutions worse than they'd started. When you lose money, it hurts. When you lose borrowed money, you're left with debt and no assets. So this was happening on a massive scale. Second, the banking system was fragile. In 1929, the United States had thousands of small banks. Most operated in just one town or city. There was no federal deposit insurance. If your bank failed, your savings simply vanished. After the crash, people started worrying about their banks. Some went to withdraw their money just to be safe. But banks don't keep all deposits as cash. They lend most of it out. So when depositors demanded their money back all at once, banks didn't have it. Banks started failing. Uh, each failure made people more worried. It's own, it's leading to runs on other banks, leading to more failures between 1930 and 1933. Roughly 9,000 American banks failed. Yeah. Think about that number, 9,000. If you'd been a responsible person who never touched the stock market, who kept your money safely in the local bank, you still could have lost everything through no fault of your own. Third, the crash destroyed confidence and spending. Even people who didn't lose money in the market saw what was happening around them. They saw neighbors lose jobs, stores close, banks fail, uncertainty was everywhere. So they stopped spending, they saved whatever they could, they put off buying new things. Businesses saw their sales fall, so they cut costs, which often meant laying off workers. Those workers then had even less money to spend, so business sales fell further. It was a vicious cycle, and it fed on itself. Fourth, there was no real safety net. In 1929, there was no unemployment insurance, no social security, no food stamps or welfare programs. If you lost your job, you relied on savings, which might be gone, or on family and charity. The government didn't step in with relief programs, at least not right away. President Hoover believed strongly in limited government and thought private charity and local efforts would handle the situation. They couldn't. The scale was too large. Fifth, international factors made things worse. The crash in the United States rippled across the world. European economies, still recovering from World War I, were hit hard. Global trade collapsed. Countries raised tariffs to protect their own industries, which just made trade fall further. The gold standard, which linked currencies to gold, made it hard for countries to use monetary policy to fight the depression. It was a global economic catastrophe, and the interconnected financial system spread the pain everywhere. And sixth, the policy response was inadequate. With the benefit of hindsight, economists now believe that both fiscal and monetary policy made things worse. The Federal Reserve, fearing inflation, actually tightened monetary policy when it should have been loosening it. The government tried to balance the budget when it should have been spending to create jobs. These were well-intentioned mistakes, but mistakes nonetheless. The tools to fight a depression existed, but policymakers didn't fully understand how to use them yet. All of these factors interlocked. The crash triggered bank failures. Bank failures destroyed savings and credit, lost savings, and credit crushed spending. Falling spending led to unemployment. Unemployment deepened the crisis, and all of this was made worse by policy mistakes and a weak international system. By 1932, the Depression was in full force. Unemployment in the United States reached 25%. In some cities, it was higher. Families lost their homes. Bread lines stretched around blocks. Shanty towns called Hoovervilles, named bitterly after the president, sprang up in parks and empty lots. Dust storms ravaged the Great Plains, forcing farmers off land. Their families had worked for generations. This was the aftermath of the bubble. the consequence of believing prices would always rise, the price of forgetting that borrowed money must be paid back, and that markets are made of human beings whose confidence can evaporate overnight. Franklin Roosevelt was elected president in November 1932. He took office in March of the following year. His administration moved quickly to address the crisis. Within his first 100 days, a wave of legislation reshaped American finance. The government closed all banks temporarily for a bank holiday and then allowed only sound banks to reopen. This stopped the panic of bank runs. Congress created the Federal Deposit Insurance Corporation, the FDIC, to insure bank deposits. Now, if a bank failed, depositors would get their money back up to a limit. This simple innovation restored confidence in the banking system. Congress also passed the Securities Act of 1933 and the Securities Exchange Act of 1934. These laws created the Securities and Exchange Commission, the SEC, to regulate the stock market. For the first time, companies had to disclose meaningful financial information. Fraud and manipulation were explicitly illegal with real penalties. Margin requirements were limited. You could no longer borrow 90% to buy stocks. The rules were tightened to prevent the kind of leverage pyramid that had made the crash so devastating. The Glass-Steagall Act separated commercial banking from investment banking. Regular banks that took deposits couldn't also be in the business of underwriting securities. The idea was to protect depositors from the risks of speculation. This separation would last for decades until it was gradually repealed. Near the end of the century, the New Deal brought many other programs. Social Security provided a basic safety net for the elderly. Unemployment insurance helped people who lost jobs. Government work programs employed millions to build roads, bridges, dams, schools. These programs didn't end the Depression immediately. The economy remained weak throughout the 1930s. Full recovery didn't come until World War II, when massive government spending for the war effort finally pulled the economy out of its slump. But the regulatory changes lasted. The framework built in the 1930s, the SEC, the FDIC, the margin rules, the disclosure requirements became the foundation of a modern American financial regulation. These institutions were a direct response to the disaster of 1929. They were, in a sense, lessons learned and encoded into law, lessons for modern investors. So what can you, as a modern investor listening to this in the 21st century, take away from this old story? Let's think through a few key insights gently and without drama. First, understand leverage deeply before you use it. Margin and borrowed money can amplify your gains, yes, but they amplify your losses just as powerfully. In a falling market, leverage can wipe you out completely and leave you in debt. Many investors in 1929 thought they understood margin, but they didn't really grasp what would happen if prices fell sharply. They assumed prices wouldn't fall sharply, which is a very different thing. If you choose to use leverage, make absolutely certain you can survive a worst case scenario. Ask yourself, what happens if my investments lose half their value? Can I meet margin calls? Can I hold on without being forced to sell at the worst possible moment? Second, diversification matters, but it's not a magic shield. Robert, our sales manager, thought he was diversified because he owned shares in different companies, but all his stocks were subject to the same market forces. They all fell together. True diversification means spreading risk across asset classes, across geographies, across time. It means not having everything tied to one economic outcome. In modern terms, that might mean owning not just stocks, but also bonds, real estate, perhaps commodities. It means understanding that when fear takes hold, many things you thought were uncorrelated will move together. Third, beware of the phrase, this time it's different. In the 1920s, people genuinely believed the old rules didn't apply. They had good reasons for thinking that technology was changing everything. The economy seems stronger than ever. But in the end, the fundamentals still mattered. Valuation still mattered. The fact that something has gone up for a long time doesn't mean it will keep going up. Every bubble in history has been accompanied by a narrative explaining why this time is special. Sometimes there are real changes in the world, but human psychology and market dynamics remain surprisingly constant. Fourth, transparency and information are your friends. Um, One reason the 1929 crash was so devastating was that investors often didn't know what they owned. Company financial statements were not standardized. Fraud was common. Insider trading was legal. You were investing blind, trusting brokers and promoters who might or might not be honest. Today, you have access to audited financial statements, regulatory filings, independent research, endless data. Use that information, understand what you own. If you don't understand an investment, don't buy it just because someone says it's the next big thing. Fifth, emotional discipline is perhaps the most important skill in investing. The investors who survived 1929 best were those who didn't panic, those who held cash, who had diversified, who didn't use too much leverage, were able to wait out the storm. Some even had resources to buy when prices were low, but beyond just having resources, they had the emotional strength not to follow the crowd. It's incredibly hard to stand apart when everyone around you is either euphoric or panicking. It's hard to be cautious when your neighbors are getting rich. It's hard to buy when everyone else is selling in fear. But that emotional discipline, the ability to stick to a plan, to think long term, to ignore the noise, that's what separates successful long-term investors from everyone else. And sixth, remember that no one can predict the future. In 1929, experts got it wrong, bankers got it wrong, the government got it wrong. Everyone thought they knew what would happen next, and they were mistaken. Today is no different. Pundits and analysts make confident predictions, but the truth is that markets are complex systems influenced by countless factors. You can understand history, you can understand principles, you can make educated decisions, but you cannot know with certainty what will happen tomorrow or next year. Humility in the face of uncertainty is not weakness, it's wisdom. One more thought. It's easy to look back at 1929 and think those investors were foolish, but put yourself in their shoes. If you'd lived through years of rising prosperity, if you'd seen your friends and neighbors making money in the market, if respective voices told you this was the path to security, you probably would have done the same thing. They weren't stupid. They were human. They were responding to the incentives and information they had at the time. The lesson isn't that they were bad investors. The lesson is that all of us, you and me included, are vulnerable to the same psychological traps: overconfidence, herd mentality, recency bias, the belief that good times will last forever. Knowing these traps exist, it doesn't make you immune, but it might make you a bit more cautious. The long view: the Great Depression eventually ended. The stock market eventually recovered. It took 25 years for the Dow to climb back to its 1929 peak, but it got there, and then it kept going. The American economy grew, new industries emerged. The people who held on, who didn't sell everything in panic, who kept investing through the dark years, eventually saw their patience rewarded. This is worth remembering. Markets move in cycles. Booms are followed by busts. Busts are followed by recoveries. Over the very long term, the trend has been upward because economies grow, because human ingenuity finds ways to create value, because businesses adapt and evolve. But that long-term trend is interrupted constantly by setbacks, crashes, recessions, moments of fear and doubt. If you're investing for the long term, if you're thinking in decades rather than days, then crashes are something you will live through, not once, but multiple times. Your portfolio will fall. It will feel terrible. You'll wonder if you made mistakes. You'll be tempted to sell. And the key question is whether you'll have the structure and the mindset to hold on. That structure means not being over leveraged. So you don't get forced out. It means having an emergency fund so you don't need to sell investments to pay bills. It means diversification so your entire life doesn't depend on a one asset class. And that mindset means understanding that volatility is the price you pay for long-term returns, that falling prices create opportunity if you have the resources to take advantage, that the goal isn't to avoid losses, but to survive them and keep going. The investors who came of age after the Great Depression were shaped by it. For decades, they were cautious, skeptical of debt, distrustful of stocks. That caution had costs. Some missed opportunities, but they also avoided the kind of catastrophic mistakes their parents had made. They understood in their bones that risk was real. In more recent times, as those memories fade, as new generations entered the market without direct experience of a true disaster, some of that caution faded too. The financial crisis of 2008 was a reminder that crashes still happen. The rapid rise and fall of various tech bubbles and crypto booms and meme stock frenzies are smaller echoes of the same dynamics. The details change, but the pattern is familiar. Optimism, leverage, momentum, belief that this time is different. And then the moment when the music stops, it's late now. The story of 1929 has unfolded. You've walked with me through the boom, the crash, the long depression, the recovery, the lessons. These events happened almost 100 years ago, but the principles beneath them remain relevant. Human nature hasn't changed. Greed and fear still drive markets. Leverage still amplifies outcomes. Crowds still move together. And patient, disciplined investors still have an edge over those who chase excitement. Maybe tomorrow you'll look at your portfolio with slightly different eyes. Maybe you'll ask yourself whether you truly understand what you own, whether you're taking risks you can handle, whether you're prepared emotionally and financially for the inevitable downturns? These aren't exciting questions. They don't promise quick riches, but they're the questions that matter. The markets will open again in the morning, prices will move, some investments will rise, others will fall, news will break, opinions will flow, and it will all feel urgent and important. But underneath all that noise, the fundamentals remain. Own good assets. Don't borrow more than you can repay. Diversify. Be patient. Stay calm when others panic. These simple rules won't make you rich overnight, but they might keep you in the game long enough for time and compounding to work in your favor. Take a slow breath now. Let your shoulders relax. The charts and tickers and account balances can wait until tomorrow. You've done what you can. You've thought carefully. You learned from the past. That's enough for today. The crash of 1929 is history. The Great Depression is history. But the wisdom earned from that suffering remains available to anyone willing to listen and learn. You've listened tonight. Now rest. The markets will still be there in the morning, and so will you.